Welcome to Swimming with Allocators. I'm Ernest Sweat, and each episode, Alexa Benz and I give you a VC podcast from the LP perspective. You ready? Let's dive in.
Today we are speaking with Nate Leung, partner at Sapphire Partners. Sapphire Partners is a limited partner with over $1 billion in investments in elite early-stage venture capital funds across the US, Europe, and Israel. Sapphire also is the engine driving #OpenLP. Our guest, Nate, has been every sea creature in the venture food chain, operating at Optimizely, investing at Bain Capital Ventures, and allocating at Industry Ventures. Nate, you have always been so generous with your guidance and introductions. It's a real pleasure to be able to share this time with you. Thank you.
Thank you for having me.
Nate, from your experience and, on the venture side, kind of at Bain and then industry and now Sapphire, what are some of the key learnings that you've received or, like favorite stories that have really shaped how you look at the asset class today? Because, I'm not going to say the number, probably the same amount of years I've been in industry or a little less, but it's been a wild ride. So what have you taken away and what keeps you sharp on the industry today?
Yeah, I think it's almost a core principle, or like just it's a people business. It's a relationship business. And this is it's a repeated game, so to speak. So it really matters how you treat people and how you develop relationships. I think, and I think that's been just a thread that's gone from each step in my career, at least, and helping shape kind of where I think the opportunity set is going forward too. And what I mean by that is I think, by being a long-term partner and going through sort of cycles and being able to be a sort of consistent investor through cycles, creates opportunity to kind of do more with the folks you're partnered with, and I think that's really exciting, especially like going through macro challenges and things like that.
Could you give us the story behind Sapphire Partners? I know you all when I think of LPs that are leading the charge in thought leadership, and trying to kind of raise the bar for the entire allocator stakeholder group, I think of you all. But could you tell the kind of the story and from when it started to what it does now?
Yeah, actually, I'll start with today, and kind of jump backwards. Today, we're an $11 billion venture capital asset manager, investing in both funds and companies. And that is actually what we had been doing when we started about 12 years ago now. And even before that, the team that's, before my time here at Sapphire, the team had spun out of SAP Ventures, and became, independent, became Sapphire Ventures. And when we launched, had both a direct investment strategy as well as a fund investment capability. And from the beginning, on the fund side, we've been seeking exceptional venture fund managers, focused on early stage, both established as well as emerging. And that's sort of the thread of for our investment strategy that's been very consistent. We've consistently wanted to partner with the very best GPs, and that's both new and established.
And you've recently announced you're launching a new emerging managers program with a big time solo LP, CalSTRS.
That's the correct. Yeah, that's the big change actually this year is that on our funds platform, we'd added dedicated capital for emerging managers defined as funds 1 through 3, which we had previously been, fairly active in partnering with, new and upcoming GPs, but it was always out of one pool of capital. And what we did in partnership with CalSTRS that we announced this fall was to segment that out as a dedicated program, entirely funded by CalSTRS. I think that, especially in this time, there's a tremendous opportunity set that we're excited about pursuing together. And maybe I'll take a step back and talk a little bit about CalSTRS and sort of the origin of this partnership. CalSTRS had been investing in venture and backing emerging managers, for over a decade now. Too, they've been very active, great long-term partners in the ecosystem, and that said, they'd been kind of doing it, broad-based in private equity in general. And as we had conversations and developed the relationship, we shifted that program to really focus on venture, and that ended up being a really good fit for both what both groups were trying to accomplish in terms of backing and finding and backing the next generation of great managers.
Is there anything else that's helpful on this platform? We have a lot of emerging managers listening that you'd love to clarify or that they should know about this new program.
Yeah, I think the most important thing and the reason why we did it is frankly the mission of serving the teachers of California was really compelling for us, both from what the mission stands for as well as the institutional quality of CalSTRS as a partner. There is as institutional as it gets, right? Over 330 billion in assets. Been investing in private equity for decades, partnered with some of the very best GPs, since their earliest days. And so we saw this partnership as a way to accelerate kind of both of what we were doing, and the mission was really compelling for us to support. And for the emerging managers out there, that is the mission that this capital supports too. So
one question I wanted to ask is, given that you guys have experience with emerging managers as well as kind of established fund managers, how do you, the criteria for both is, I would assume, be different. Can you provide some kind of insight on kind of how you judge or, how you diligence both, whether they be new opportunity or follow up?
Absolutely, a great question. And you're right that they're different, but our process isn't much different, if that makes sense.
Yeah.
What's different is the track record, right? Like the amount of and maybe just the typically when we've been partnered with a group, there's we've seen the consistency of a certain strategy play out, and with a new relationship and a new partnership, you just don't have that sort of working relationship. So the key difference, I would say, is probably around the kind of data that you can look at and rely on versus the more qualitative kind of analysis. And then, a history of partnership, like years or fund cycles of a partnership, is a different consideration than sort of a brand new relationship, right? And so what I think is very helpful, and maybe this is sort of a pin in the advice for emerging managers, is how to develop an authentic working relationship, before you're sort of officially partnered, in a fund. Like whether you're raising your first fund or second fund and thinking about cultivating new relationships, a tool that I've found really helpful, and this kind of goes back to my industry ventures days and frankly my Bain Capital days, where co-investments were a great way to partner with potential LPs or with these and also with existing LPs. I remember one of the investments one of the earliest investments I did at Bain Capital was it was investment that we were leading, but it was a sizable check, and we brought in an LP to join for the diligence meetings. And that, became that was a large part of industry ventures strategy as well, which is to do co-investments and partnership with GPs. And now, particularly in this market where capital is more scarce, and where opportunities and valuations feel more, either more logical or more stable, more market, can be attractive, and a great way to, get to know how to work with an LP and work alongside them, have them see your diligence, experience your diligence, firsthand, which I think is really exciting and a great way to build a relationship.
Yeah. And then for the established funds, it's my assumption, and what I'm hearing in the market is that, a lot of firms expanded scope significantly during this low interest rate environment. We had very high prices and valuations, and a lot of those companies, I think the latest stat I saw is there's about 1,200 unicorns. And usually only about 20 tech companies go IPO every year. I mean, on average over the last, I guess, 20 years. And so, or maybe that's at most, but whatever the fact is, like, there's a huge bottleneck, right? And so when it comes to allocators and them diligencing their relationships with established firms, what are even just, like, you can say, detailed high level thoughts? How do you take that into account when people could be at a point of, like, having a lot of success and plateauing and not being relevant anymore?
A very good question, and sort of a lot to unpack. I'll start with I'll start with at the sort of portfolio and company level. I think we try to get as much information as we can on actual company performance and really understand, how real are the fundamentals around the value drivers? How real are those valuations? And there are two. I think there's several layers to it, but the ones that sort of stick out to me are, what are the things that are actually measurable, around revenue, profit, capital raise, preference, capital structure, and capital stack. And then how does the GP talk about them, right? Or how's it presented, right? Like, are things held at the last round valuations? Or are things, sort of adjusted for might be appropriate today? And how do they discuss, the sort of current state of the investment, and what's that sort of, level of communication and transparency? It's like, frankly, what can you really trust?
Yeah.
And there's variation on both sides of that, right? But hopefully, like, the fundamentals stuff, like, is like, numbers are numbers, and hopefully there's some truth behind that, and not like accounting irregularities. But then how the partner, sort of discusses that information and shares that information is really important in terms of how we think about underwriting. And then we try to bring it full circle, really, with the references that we do, through the ecosystem with founders, co-investors, and really try to assess, how close the existing body of investment work really informs the go-forward investment strategy.
And at the time we're recording this, Nate doesn't have to respond, but, like, we had a pretty big firm that just decided to go bye-bye. So I'm sure it's making the assessment of firms very tough for allocators today.
It's absolutely, and those are sort of the issues that are particularly challenging to get under, right? The partnership dynamics, the individual motivations, right? And there's only so much that LPAs, economics, GP commitments, and things like that, only so far that they can go.
Yeah.
I think it's been a really interesting time, and certainly unfortunate, but I feel like this is also there's probably more to come.
Yeah.
But I think that also creates the space for the next generation of really great firms and managers.
Is there anything in those re-up conversations that you can sort of shine light on what you're thinking about?
Yeah, well, so I think this is I'll step back and discuss maybe a little more about our process. Actually, whether new or re-up, we try to spend as much time as we can with the broader investment team, in general, to really like assess some of these dynamics. And sometimes certain team dynamics are more call it obvious risk factors, right? Like a team that's never worked together or never invested together before might be different, right? Than a team that had been, making investment decisions together for a decade, right? And so certain times like those issues are more important, and then on the other side of this, like where particularly with established managers, where the there is a question of sort of transition of economics and frankly even like transition of sort of investment decision making. Like it's a process, right? It doesn't just happen sort of overnight. And I think one of the trends that we've been observing is sort of a bifurcation in the market of like very large brands or large platforms, large firms versus specialization. Right, specialization by vertical or stage or what have you, and maybe like a horizontal trend, kind of that across both is actually the importance of an individual brand, right? Meaning like an individual GP or investor kind of brand, like what they stand for, and that person being the go-to person, right, for referral or for inbound or whatnot. And those two kind of overarching trends, I think, are driving a lot of sort of the changes of what we're seeing in the ecosystem in venture.
Yeah. Are you seeing that among your allocator colleagues as well?
That's a great question. It's anecdotal at best, but I think that is true too. I think there are more, there's increasing specialization in terms of allocators. Now, I'm not talking about like, when like longstanding endowments or pensions sort of shift their kind of staffing model. I mean, like just where capital is kind of going, and where talent is going. It feels like there is also increasing specialization, which is interesting, whether it be sort of by asset class, by transaction, or even firms kind of pursuing like different strategies for like exposure to a space. And I'm sure we'll get into secondaries, for example, but that's definitely been an area of tremendous growth and change.
Yeah, I wanted to actually, since you teed it up, love to talk about secondaries, given just all the fluctuation in the market, and some emerging managers looking for liquidity in interesting ways, or some of their, let's say, newer allocators to the space looking for liquidity. It's been something that we've seen from the fund level as well as at the individual portfolio company level as well. So you've had experience from your time at industry. What kind of guidance would you give to other allocators and LPs on secondaries?
Yeah, I'll take a step back and just think about like the overall market context, which is we've gone from a period of relative tremendous liquidity, right? Like in sort of the peak sort of periods, right? Like in 2020, 2021, sort of like you would see secondaries trade at at par or at premiums, right? Like it felt like there was a lot of liquidity in the ecosystem, and very quickly that liquidity evaporated. And I think where we are now is a bit in a normalization sort of period of like, I think liquidity is going to, for a longer period, be harder to come by. And that is still largely working its way through the ecosystem. That said, over the past cycle, like there's never been more capital raised into secondary vehicles, right? Like, and this is across alternative assets and private assets. Like there are $20 billion or larger secondary funds.
Wow.
It's and that is more in buyout and private equity for sure. But there's also never been more capital, chasing venture and growth and technology assets too. So like the ecosystem has kind of changed, tremendously. And in terms of, I think advice for LPs, I think I would have conversations and just, assess what sort of the kind of options are out there. Talk to folks in the ecosystem and really think about like what your long-term strategy is. Frankly, like I think about like what is your from first principles, your long-term strategy? Like what are the kinds of managers you want to partner with? How do you want your portfolio to be constructed going into the next cycle, right? And if it makes sense to change, what's in your current portfolio in order to accommodate what makes sense in terms of like your go forward portfolio construction and investment strategy, then I think, secondaries are a great tool to really think about that and to really be able to like, take liquidity or reallocate, from either certain asset classes or from, certain even specific investments.
Is there anything else about secondaries that you feel like people are getting wrong?
Yeah, I think there's still a perception, and there's variability on both ends in the ecosystem. I think there is still a perception that it's still a bit of a gray area, dirty word, right? Like it's still like emerging as an appropriate like liquidity solution, but that's exactly what it is. It's a solution, right? So like, and this is where I think there's going to be more sort of creative structuring and more players, frankly, in the space. We've seen. I have tremendous respect for the team at Industry, for example. They've grown a lot, right? Like the latest secondary fund is $1.4 billion, I think. And when I was there not too long ago, it was, half that or smaller. And so it's different. But I think the overall ecosystem is moving in a direction where I think hopefully liquidity and liquidity solutions will be more kind of commonplace, or more widely accepted and adopted. And I think that on the other side of that, like there's been a lot of hype, right? And I think there's been a lot of hype around secondaries being, counter-cyclical, right? Or like being able to find incredible assets for cheap. Like the reality is most folks aren't selling their incredible assets, period, let alone for massive discounts.
Yeah.
Right. And so the perception that there's all this value to be had just hasn't been, frankly, really been unlocked yet. But I think as expectations on buy and sell sides start to converge more, I think the overall market and the velocity of the market will start to pick up.
You've been quoted as saying, "I love being an allocator." So, just as somebody who's been both a VC and now an allocator, what's something that you've learned being on both sides, or what are some of the misconceptions that when you were a VC that you wish you would have known about allocator?
I think about, and this kind of goes back to one of the principles kind of throughout my career, which is in the ecosystem, investments are not transactions; they're partnerships, and therefore, closing an LP is not a sale, It's the beginning of a relationship, actually,
Totally.
right?
It's
And
it's a proposal.
That's right. That's right. This is
Yeah.
it's like this is the start, you
Yeah.
know, of the marriage long-term partnership. And I think it's really important to kind of keep that in mind, because I think, you know, when things were a lot easier, and in the prior cycle, right, like everyone was moving fast, and not doing as much work and deep thinking as should have taken. And I think, you know, personally, I'm guilty of this, right? So definitely, but I'm excited about going forward, deepening relationships, and also building new ones, and supporting, you know, new folks getting into venture as well. I think authenticity is also kind of a misunderstood thing in venture, right? I mean, because I think there's a tension. So much of what happens, or what drives activity, can be around brand, right? And around heat and around hype, because you're thinking about the future, right? You're thinking, like, there's a lot of discussion about potential. And I think, you know, it's maybe a human condition, but we can get kind of carried away. And so the like truth and authenticity, I think, gets sometimes undervalued. And I also think this goes a little bit back to the secondaries sort of conversation, but I think duration of venture investments is also misunderstood, right? Like, we've anchored around a 10-year fund life, you know, with 2-year extensions or whatever, right? But like, the reality is things change, maybe in a shorter period than expected, or like maybe it takes longer. Like, a lot of times, you know, things take a lot longer than 12 years to really realize value. And like, you know, I think different LPs, different allocators, have different time horizons, right? And I think, you know, same thing with GPs. I think folks have different expectations. Like, you know, frankly, I've been, you know, in this business as an LP for 8 years, and that's not even close to a full cycle yet.
Yeah. You don't know if you're good yet. You're like, the data's still out. It's still on paper.
Now we're going to take a quick break to speak with our sponsor.
On the show today, we have industry expert and sponsor, one of my all-time favorite founders, John Ling, co-founder and CEO of Canopy. Canopy streamlines the administrative process. Think legal, wires, taxes, etc., for private equity co-investments and SPVs. Thank you, John, for partnering on the show. A lot of the LPs who come on the show are particularly interested in co-investment opportunities. In many cases, they're investing with emerging managers with the intention of putting more money to work in SPVs like what you're setting up. Any trends you're seeing in the co-investment space too that might be interesting or a takeaway for the audience?
Yeah, I mean, I think to iterate your point, I do think, you know, institutional LPs are thinking a lot about like, why are we paying such expensive fees, right, to these like large funds? Like, how do we get more direct access? I think, you know, as you talk to a lot of these institutional LPs, I think, you know, that'll be a big theme, right? Everyone's like, oh, how do we get more direct access? And I think, you know, from the GP's perspective, they aren't like against it, right? But it's just a lot of work. I think both on like the legal component, right? Getting like the financials, right? Flow of funds component set up, etc. Like, I think if they had a really easy way to do it, I think they would be willing to. Because at the end of the day, you know, for them, it's not necessarily like free carry, but like, if you are under the sort of assumption that, you know, we're investing in a really, really good company, it's definitely going to go up, then actually you sort of can think about it that way, because the alternative is like, what you can't write it from your fund, right? So you'll probably end up just like introducing the LP to the portfolio company as like a gesture of goodwill. But if you were to set up something that's just like, hey, 10% carry, like, you know, maybe like very, very low management fees, like people would just be like, oh, okay, you know, that kind of makes sense. And actually you can just pull more capital from your LPs. I think a lot of the times maybe people are a little bit too aggressive, I think, on their numbers. I think if you talk to institutional LPs, they probably give you the same feedback where like, why am I paying like 2 and 20 on like a co-investment vehicle? Like that doesn't make that much sense.
Yeah.
So I think like, if people were just, hey, it's really easy, it's not that expensive, we get a little bit of money, but like obviously the alternative is you get none of it. Like I think that calculus is not super complicated to make.
Yeah. Do you see the carry? Are you seeing more an average go down? Like, is
I
carry
mean,
now closer to 10%?
I don't think it's necessarily close. I mean, I guess it depends on how you think about our clients and our
Mhm.
sort of like the types of deals that we do, right? So I think like actually we have customers who come on and do like 0% carry
Yeah.
actually, because I think from the portfolio company's perspective, they were like, okay, we want one check. We don't want a bunch of introductions to your LPs. Like just tell us how much like you're able to do. And it sort of ends up functioning as like a gesture of goodwill, right? Like
Mhm.
these LPs will pay for our fees, right? Like just like the entire process. But at the end of the day, they keep all the upside. I think like 10% is a fairly standard number when you think about, large scale co-investments. Obviously,
Mhm.
there are still people who charge 20. There are people who do side letters, right? I think our system is capable of like very easily configuring and automatically generating like side letters for folks as well.
Mhm.
Um, but yeah, I think like to my point earlier, it just makes a lot of sense to not charge that much, to be honest, right? Like I think everyone wins in the end, and there's no need to say like, oh, how can I get that like extra dollar? Um, right? And then you sort of like build
Yeah.
more goodwill too. When you like go raise your next fund, people will be like, well, actually, yeah, they didn't really charge us carry on that. Maybe we have more opportunities to get exposure to really great companies through, Alexa and her fund, right? Like, I
Totally.
think that's sort of how I would think about it if I were building a fund. I don't run a fund, obviously, but like, I think that's probably how I would prefer to think about it. Like, very long term game, right? At the end of the day, like VCs, like,
Mhm.
let's say 10-year asset class, especially if you're like very, very early stage and you need the late stage capital to like bridge your co-investments, right? Or your pro rata rather, sorry. Like, because if you have a really large fund, you probably don't care about this. You're probably just like, okay, actually, why do we need to do co-investments if we have like a $2 billion fund, right? It's a
Yeah.
completely irrelevant question. So I think like if you're like a really early stage investor, it really is about like, how do you, have a lot of like repeat win-win transactions with your customers. And I think that's how
Mhm.
I like to think about it.
Yeah. Yeah, absolutely. John, you clearly are out ahead on the future of venture capital. For those interested in using Canopy software to set up funds, manage capital, and report performance, you can please visit heycanopy.com/allocators. And then Ernest and I get credit for sending you. Thanks so much. And now back to our LP interview. Are there any stories you can share of, building a relationship with somebody over time, or what that's been like?
I've been really excited and grateful to bring a relationship and a partnership full circle. So I'll start with the group is Workbench. I'm not sure if you're familiar with them.
Yep.
They're an enterprise fund based in New York. And I had originally worked on a partnership with them at Industry Ventures. This was, one of my earlier deals. The first fund was entirely owned by a corporate, and we helped them restructure it and bought half of it. There are some great assets in there. That fund today is north of a 3x, with like great pathway. And that transaction was, back in 2017, right? So like this is like really excited about that early return. We also came into Fund 2 as an anchor investor. And I've gotten to, when I left industry and joined Sapphire, continue developing that relationship, from a, admittedly a bit more of a distance. But now excited to share that we've come into their most recent fund, but we've come in with a substantial, actually even larger commitment that we wrote at Industry Ventures. And it's now been 7 years in the making that this relationship's developed. We've done co-investments together, and I've just gotten to know them as people, share kid photos, all that stuff, and
That's awesome.
it's an amazing personal and professional kind of relationship. And I think they're just getting started, right? So they celebrated their 10-year anniversary, and we're really excited about the coming 10 years or more.
Well, thank you. Any parting words? Is there anybody that you want actually to reach out? What is the criteria of people who are the kind of people you'd like to talk to, and so that they know what you want?
Yeah, two things. One is for emerging managers raising their first 3 funds in the U.S. We're excited, and we actually manage all of the introductions and inbound through and inbox fund submissions at sapphireventures.com. So it's FUND submissions at sapphireventures.com.
Awesome.
And then if any folks, whether they be LP, GP, are interested in exploring, secondaries or just talking about potential liquidity solutions, I'm always excited to jam on conversations like that.
That's awesome. Nate, you are a resource for me in all things. So anybody would be lucky to pick up this thread. Thank you so much.
Thank you.
Thanks, Nate.
See you later, allocator.
After Portfolio Tile, investing with a smile.